And good morning, everyone. My name is John D'Antone, and I'm the Director of Marketing here at CAPIS. Welcome to our November monthly research briefing. CAPIS would like to thank all of you for taking the time out of your busy trading day to spend with us here. We hope that you find the following information in today's call useful. Also, take note, CAPIS has a new looking website, as you can see by the step and repeat behind me. So we invite everyone to check out our new and improved CAPIS website at www.capis.com. We hope the simplified format and navigation help you learn more about CAPIS and or to interact with us. Be sure to continue to follow us on social media platforms such as Twitter, LinkedIn, and YouTube, where a replay of today's event will be. Now, before we get started, of course, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now, of course, on with the briefing. And I'd like to turn it over to Nick today, but before I do, please remember that he will take questions at the conclusion of his remarks. I ask that you kindly type them into the Q&A portion of your Zoom, and I will be sure to get them and Nick to answer. And now, it's my honor to present Nick Colas, one of the two founders of DataTrek, a research consultancy focusing on market fundamentals designed to make the investment process more profitable, robust, and efficient. Nick is a 30-plus year veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity auto analyst at First Boston, now Credit Suisse. From 1999 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Colas was the director of research and chief market strategist for first Rochdale Securities and then Convergex Group. Nick, as always, welcome.
Hey, thank you so much. And let me add my thanks to the audience for taking the time to listen in today. We're going to go through 5 topics in a fairly quick fashion, take about 20 minutes in total. The 5 topics, just to give you a preview, are first, U.S. midterm elections and their effect on markets. Second, the expected path of Fed policy versus what the Fed has told us they're going to do. Third, the causes of U.S. inflation. This was a request from the CAPIS team themselves, how much of it's been related to supply chain versus aggregate demand issues. Fourth, where U.S. equity fundamentals currently stand and what markets believe about the future. And then finally, what we're telling about our clients about what's going on in stock markets right now, where the bottom might be, and how to trade the current market. So that's going to be our discussion list for today. Let's kick off with the midterms, which obviously just occurred. Votes are still coming in on some of the marginal House races, but we have a pretty good handle on what's going on. Certainly was not what markets were expecting. We use predictit.org as a proxy for what markets expect going into big political events like the midterms. And Predictit users, which is basically a small money wagering site, but very prescient about a lot of events before they occur, they were giving very good odds for the GOP to retake both chambers of Congress and with some conviction. I mean, they were looking for a pretty clean sweep. And that made sense in a lot of ways. If you look at history, there's a great Gallup survey or Gallup analysis of their surveys around midterms. And the Gallup analysis shows that when a president has approval ratings below 50%, his party loses an average of 37 seats in the House during midterms. But when approval ratings are over 50%, they lose just 14 seats, but they lose either way. President Biden's approval rating has been stuck in the low 40s for a long time, so it was logical to think that the GOP was going to be able to retake the House with quite a large majority and even take back the Senate. But with races still being counted, it looks like the max GOP pickup is going to be like 19 seats. They'll still take control of the House, but the Senate staying with Democrats. And the bottom line is this was not what was expected and not what history told us to expect. So quite an anomalous outcome. That being said, I mean, markets basically just want certainty on politics. They do at the margin prefer when one party controls both sides of the aisle, both chambers as well as the White House. But at the margin, what they want is certainty, and we did get certainty. There will be, a fair amount of gridlock now for the next 2 years in DC. Not a lot of big policy movements in either direction as a result, and so markets have their outcome. So that's basically the short thing on the midterms. It was not the expected result. It was not the expected result based on history or then current consensus. But at the same time, we have a result and markets can move forward. Point number 2, expected path of U.S. monetary policy. And we use Fed funds futures literally every other day with our clients to discuss what's going on in the market as far as future Fed policy expectations go. And the data I'll give you now is literally from this morning. So this is the current state of play as far as what markets are looking for Fed policy. So December meeting, the next one coming up on the 14th, markets give 81% odds of a 50 basis point increase. Very small odds, less than 20% of 75. So 50 is what's baked in the cake for December. That would take Fed funds to 4.25 to 4.5 at year end. There is no January meeting. The next meeting after that is in early Feb, I think Feb 1. And there's fairly even odds right now, 45% aside, between either 25 or 50 basis points as being the next rate hike. That would get Fed funds to either 4.5 to 4.75 or 4.75 to 5. So that's the range we're talking about over the next 2 meetings, a 50 basis point increase in December, and then 25 or 50 in February. Now, past that, if you look at the March contracts, right now, it looks like if there's 25 in February, there's going to be 25 again in March. If there's 50 in February, then maybe another 25% in March as well. It's kind of 45% odds either way. But that gets us basically to 5 and 5.25. Now, the funny thing is that past March, Fed funds futures say no more rate hikes. Rates stay static at either 4.75 to 5 or 5 to 5.25. So what we have is basically a couple of more rate increases than markets assume. Kind of 5% is the level. It could sway a little bit either side, but markets think that past February and March, going into May through September meetings, we got level rates, 5%, give or take 25 basis points. The interesting thing about this is that if you go to November and December contracts, there is some chance of a token, say 25% basis point cut in rates towards the end of next year. That would make the rates end the year somewhere between, say, 4.25 to 4.5, 23% odds there. 4.5 to 4.75, kind of 29% odds, and then almost even odds on the other side of the coin of 4.75 to 5. So markets are thinking that we see peak rates sort of towards the middle of the year, and then we get some modest rate cut going into the end of the year, presumably because the economy has slowed down, inflation is tracking much lower, and as a result, the Fed can kind of take their foot off the brake pedal and begin to let the economy grow again, or at least not go into a deeper recession by cutting rates just a little bit. That's the consensus. Now, here's what's strange, and I think very strange, because at the last press conference he gave, Chair Powell was very open, saying that even though the Fed is thinking about the lagging effect of monetary policy on the U.S. economy, they are going to be raising their interest rate expectations at the December meeting. Recall that the Fed puts out a quarterly summary of economic projections, and the famous dot plot of future Fed policy expectations have been running about 4.4% for this year and 4.8% for next year. And he point blank said during his comments that the Fed would be raising those expectations at the December meeting. So the fact that we had a 4% expectation going into this meeting in December for Fed funds at the end of next year, and the market is saying, we don't quite believe it, we kind of think they could be lower, says the Fed right now doesn't have 100% credibility with markets. Markets are thinking that because of things like the last CPI and PPI prints, and some signs of economic slowing, perhaps we're going to get some rate cuts at the end of next year. And that's the real tension right now in markets, because the market's thinking, okay, the Fed's mostly done, and the Fed doesn't want the market to believe that they're mostly done. The communication is still fairly hawkish. And so as much as we're getting some good CPI data and inflation data recently, The Fed does not want to let up just yet. They don't want to let the market really believe in a pivot to lower rates until they see inflation come down a whole lot more. And that's going to take months to happen. The Fed very famously looks at 3-month rolling averages of anything, economic growth, retail sales, inflation, all of it. They want to see a trend. We don't have a trend yet. And so that's the fundamental tension. That's why you're seeing markets kind of off the last couple of days, because Fed speakers are saying, yeah, 5% is probably the right number. And the market is not really pricing that in yet, either in Fed funds futures or in 2 years. So that's the tension going on here. The third point, and this was the question that some folks at CAPIS raised, they wanted a breakdown of US inflation and inflation pressure into supply chain issues and excess aggregate demand. The New York Fed actually did some work on this a few months ago and published a very useful blog post with the results of their findings, the research. And it shows that of all the inflation we've seen in 2022, the 8%, 9% numbers that we've seen in CPI, about a third of it comes from supply chain, global supply chain problems, but 2/3 of it comes from aggregate demand. And that looks about right to us from all the other work that we've done. Certainly supply chain issues have been an issue, and they're global in nature. They're really everywhere. But aggregate demand is more of the problem. We've had very high levels of employment, very high levels of wage gains, and we had all the stimulus money that flowed into the system in 20 and 21. And there's still excess household savings because of that. So as a result, aggregate demand really is the more important issue to focus on. Supply chains are less so, still important, but less so. Now, the New York Fed also keeps what they call a global supply chain pressure index. And it's a very good analysis. I encourage you to check it out. Just Google New York Fed's global supply chain pressure index and you'll see the data. They go through and look at everything from PMI surveys to lag times in shipping and come up with a measurement about how different current supply chain operations are versus the historical pre-pandemic norm. And the good news here is that the latest readings are about 1 standard deviation away from the long run mean, long run including pre-pandemic mean. So yeah, supply chains are still a little bit pressured, about 1 standard deviation more than usual, but it was 4 standard deviations at the end of last year. So we've come down a lot. Supply chain pressures really are easing. We double checked that data by actually looking at Chinese air quality across all of Chinese major industrial cities. And this is data, again, just Google Chinese air quality index and you can find the data source. And it shows that, for a lot of this year, Chinese economic output was way down, particularly in export-oriented cities like Shenzhen. Now, pollution is starting to pick back up, which correlates to higher economic activity, because when you have factories running full steam and workers driving to work and construction going on, pollution is just naturally higher, and we can monitor this day by day. And the net result of the analysis is that, yes, Chinese economic output is definitely increasing. Just literally, though, in the last week or so, basically since the Party Congress in Beijing, we've seen pickups in air pollution in Beijing, somewhat in Shanghai, somewhat in Shenzhen, but it's very, very early days. But it does show some improvement in Chinese production, Chinese industrial output, and that should further help supply chain issues globally. So we do seem to be getting some good news on that. However, and this is kind of the takeaway from this point, we still see fairly high aggregate demand. Yesterday's retail sales numbers were really strong. I mean, stronger than inflation. So there is still a lot of consumer demand. You're not seeing it in retail company earnings. We saw that from Target yesterday, for example, because they're still working through excess inventory and price markdowns, and a consumer that's become more budget conscious and more focused on getting the most bang for their buck. But this is why we're raising interest rates. This is why the Fed's raising interest rates, to cool demand from the aggregate demand side of the equation. But it takes a lot of time. It takes a long time, and we're just not seeing the impact yet. We just did an analysis for clients that looked at Google Trends, volume of searches for things like buy a house and buy a car. And yes, they've come down from earlier this year, but a lot of that's seasonal. And if you look at pre-post-pandemic data points, the searches for buy a house, buy a car, even with rates where they are right now, is still about as high as it was pre-pandemic. So as much as we've seen higher rates, they haven't really taken a bite out of consumers' interest in spending on high ticket items. Yes, mortgage rates have taken the actual housing demand down quite a bit, but car demand was pretty good in October. There still has been a shortage of inventory. So we're just not seeing the impact on aggregate demand that we want to see in order to bring inflation down. And back to our prior point, that is why the Fed is still thinking about raising rates. And the market may want to fade that sentiment, but that seems unwise because honestly, the economy is looking pretty good. One final data point before moving on, you should check out the Atlanta Fed GDP Now model. It's showing an estimate of 4.4% real GDP growth for Q4, which is amazing, given that first half was negative and third quarter was about 2%. But it does seem like aggregate demand, particularly on the consumer side, is now quite strong again. And as a result, we are seeing a fairly hot economy. Things could cool off in November, December, and obviously holiday season is super important to Q4 aggregate demand. But for the October data, looks pretty strong. We're just not seeing things roll over the way one would think, given where rates have gone this year. Moving on to our fourth point, U.S. equity fundamentals right now, based on Q3 actual earnings and what the market's expecting. Let me give you a couple of numbers to think about. The S&P earned $55.44 a share in Q3, so 55.44. That's down slightly from 56.68 in Q2, but still quite good. Q3 did not have the level of earnings or revenue beats, as you all know, that most quarters have. It was quite a sloppy quarter from that perspective. It barely beat expectations, some of the weakest beats rates in years. But analysts have been cutting their numbers as a result. And so we've got a $55 a share estimate for Q4 and Q1 coming from the street. But again, pretty good. That's earnings power of $220 a share. So if you just take the S&P right now static, it's earning about $220 a share for the next 2 quarters on an annualized basis. And those seem like pretty reasonable expectations given the economic growth data that we just discussed in the prior point. Now, what does that mean for valuation? S&P's at 3,900, divide that by 220, you get 17.7 times current earnings power. 17.7, that's a big number for a PE ratio when rates have been going up as quickly as they have, when there's fears of recession. And we're trading right in the middle of the band of 14 to 19 times that we had all through 2014 to 2019. And keep in mind that rates were a lot lower back then. So this valuation of basically 18 times earnings is pretty healthy. It indicates that markets are very confident that the S&P can continue to earn at least $55 a share for the next 4 quarters. In other words, no big earnings recession and perhaps no big economic recession. And that might seem nuts, but let me give you a thought about this as a kind of a takeaway from this part of the discussion. Companies have had a ton of warning that there is a potential recession coming. We're beginning to see layoffs, particularly from big tech, because they way overstaffed over the last 2 years. But companies certainly understand, and every C-suite, every board understands that the Fed's been raising rates and the economy is going to slow down. And so everybody should have a playbook for how to manage through a slowdown in the economy in 2023. There is literally no excuse if you don't, because this has been very well telegraphed. And as a result, companies are probably in better shape than ever to be able to consistently earn, call it $50 a share instead of 55, but something very close to what they're earning today through the next 4 quarters, almost regardless of economic activity. Now, you all probably know that the average recession sees S&P earnings drop 25%. That's a pretty standard number. A really bad one can be 50, like 2008-9 was a 50% drop in earnings. But usually it's 25. But that always comes because of a shock. So if you go back to like 1973, 79, 1990, all of those were oil shocks. First in 73 with the Saudi embargo after the Israeli war in 73, or 79 with the Iranian Revolution, or 1990 with the Iraq invasion of Kuwait, all shocks. If you go to 2000, 2002, dot-com bubble blowing up, 9/11, Gulf War II, earnings went down, but there was a shock. 2008, economic crisis caused by the bursting of the housing bubble, economic shock. So far, we don't have a shock. We have a very pre-planned, pre-programmed recession because the Fed wants to bring down aggregate demand. So it's different. This is different. Now, if we get a shock, then certainly earnings are down 25%. But if we just kind of go through the next year and think about how corporations respond to economic pressure, they should have the playbook in place to keep earnings relatively flat. And that's what the market's betting on. Pure and simple, we're at 3,900 because the market's saying earnings are not going down. They might not go up, but they're not going down very much. Because again, 18 times is a really healthy multiple. So you got to make a judgment, I think, as an investor right now about how sensible that assumption is, because it's very straightforward. There is no way around that number. If you think we can coast through and earn 55 a share per quarter for the S&P, we don't go down very much from here. If we have any little wrinkle, or if things turn out much worse, or if there's an asymmetric downside to all these Fed rate cuts, Fed rate increases, then yes, we're going down because the earnings power is going down. It's pretty much that simple. Let me close out with the three things we're telling clients about how to trade and how to invest and how to make money in this market, which is still remaining very volatile. So point number one, and this is something we've been saying all year long and we've discussed on prior calls with you with CAPIS, you got to watch the VIX. The VIX is your friend to trading this market. And simply put, when the VIX gets over 30, you should consider buying, getting long some equities, because over 30 is over one standard deviation from the long run mean of 20, 8 standard deviation. Over 30, you got to start looking at markets being oversold. And then when it gets back down to 20, you got to consider lightening up again. That's been the pattern all year long. You get up to 33, 36, the market bottoms. You get down to 19, 20, the market tops. It's been very reliable. It's happened 3 times so far. There was one rally that got killed with a VIX of 24 back in the middle of the year. But aside from that, that's been the pattern. So right now we're kind of right in between. It's a little bit of a tough call, but there is certainly a chance for a further rally if markets can digest the Fed transmission of explaining that they are going to be raising rates more than the market might expect. The second thing we're telling clients is long energy and healthcare. Energy is the cheapest group in the S&P by a factor. It's like 10 times earnings. S&P is, as we said, 17.7. And there's definitely more earnings leverage in the energy names, both in terms of commodity prices staying high and getting some PE multiple expansion, because this group has finally found religion in allocating capital more sensibly than they did from 2015 to 2019. So you should get some PE multiple expansion as managements don't expand as much, focus on current profitability, and keep earnings high. Healthcare is sort of where growth capital has to go, because tech is not right now a growth industry at all. Tech earnings growth is sub 5% next year. And healthcare is a safer place to be. It used to be that you could buy retail as a growth investor, but retail, as we've seen this year, is not very, very good growth play right now. So you're left with kind of healthcare. If you're not going to be in tech as a growth investor, you're not going to be in retail, healthcare is your final stop. And healthcare has a chance to go to 17 or 18% of the S&P. It's 16% right now. So healthcare is our other recommendation. The final one, and thinking about non-US equities for a second, if you look at the returns quarter to date for the US versus EFA, for example, or even individual countries like France, Germany, UK, and so forth, those non-US equities are outperforming in dollar terms because the euros rallied so strongly, 5-6% in the first half of the fourth quarter. So what we're seeing is non-US equities are as much a currency play right now as they are an equity play. And that's why non-US equities are doing pretty well. EM is a different story. China is not rallying as much. But even then, you've got major rallies going on in South Korea, Taiwan, India, Brazil, not as much, but you are seeing currency and stock returns both positive in some of the non-Chinese Asian EM markets. And that should continue as long as the dollar continues to weaken. The dollar got way overbought at the end of September. It's seeing some sell-off now. And again, as long as that continues, you might see non-US equities outperform in the back half of Q4 as well. So that's something to watch out for. So the bottom line to our discussion today is markets are assuming a very high level of predictability in 2 factors. The first is interest rate policy. They're expecting the Fed to be pretty much done by the middle of next year, with a shot at lowering rates next year. And they're seeing through Fed commentary to the contrary. And the second thing is S&P, US large caps, very high degree of confidence that we can coast through the next 12 months without any meaningful deterioration in earnings. Again, that might seem illogical given where we are with macro policy, given where we are with Fed policy. But that is the math. That is the way things look. So you really have to have a very glass half full kind of approach and perspective on earnings, on Fed policy in order to get long here. It's still a fairly dicey market. And that's sort of our bottom line is, we're going into the year with a lot of uncertainty, but with markets that price in a lot of certainty. With that, John, I'd be happy to take any questions.
That's great, Nick. Thank you very much. And I do have a question in the queue here. And this person asks, have you analyzed S&P yields versus Treasury 1 year of 4+%?
Fantastic question. Yes. So here's the funny thing. S&P yields right now, call them 1.5%. That's low. The difference, but there's a big caveat to this. If you look at how much of the S&P's earnings go to dividends, it's about a third. And that's a fairly constant ratio. And for those of you who sort of learned this stuff old school like I did, a third payout ratio for a mature company, like an S&P 500 company, is very fair. Like a third is a logical number. The funny thing is that 2/3 goes to stock buybacks. So if you take S&P aggregate earnings over the last year and pre-pandemic from like 2017 to 2019, all the money the S&P earned in aggregate went to stock buybacks and dividends. Reinvestment rates were effectively zero. And that's kind of odd. That's weird, frankly, because there's just no growth capital going into S&P companies. But keep in mind that depreciation, amortization, R&D, they're all included in the income statement. So by the time you get to net income, you are accounting for some growth levers that the companies are pulling. So that's all a long way of saying that yields are low, but stock buyback yields are extremely high. And in the aggregate, the S&P is paying out everything it makes in stock buybacks and dividends. So the aggregate yield is really the income yield. And by that perspective, it's pretty high and very competitive with treasuries, as you would expect, given the relatively higher level of risk of corporate earnings versus a coupon from the government. It doesn't necessarily make stocks cheap, though, because the caveat here is buybacks can get canceled, buybacks can get cut. Buybacks are not guaranteed. Dividends are different. Dividends have a very strong signaling mechanism in markets. When companies raise dividends, they mean their earnings power is higher. When companies announce a big stock buyback, all they're saying is, we have some money right now, we'll buy back some stock, but it doesn't mean as much as dividends do. So I would like to see, and this is more of a corporate finance philosophical point, but I'd like to see S&P companies shift some of the cash flow they're using to buybacks over to dividends and really reinforce the message that their earnings power is durably higher. So the yields, sort of summarizing, dividend yields, not competitive with treasuries. Overall payouts versus, including buybacks, very competitive, but the signaling mechanism of buybacks just isn't as good, isn't as strong, isn't as robust as what would happen if dividends were a greater component of that split in how companies return capital to shareholders.
Okay, Nick, sorry about that. Had a little technical issue. I don't have any more questions in the queue, so we're going to wait a minute while I read our outro. If someone has a question, please feel free to send it in now. But first and foremost, we want to thank Nick for coming to the call right ahead of the Thanksgiving holiday, the travel season. So thanks, Nick. And we're sorry we missed Jessica this time, but send our best. And of course, our next call will be on December 15th. Wrapping up our year of briefings, and it will feature the dynamic duo of the guys from Markets Policy Partners, John Fagan and Brendan Walsh, who will give us their take on all things geopolitical, both in Washington, D.C. and abroad. We have no more questions, so I'm going to close out the call then. On behalf of the CAPIS family and, of course, DataTrek, thank you so much for watching. Have a safe and happy Thanksgiving and a great and successful trading day. Thank you again.